Hi, and welcome to this video on as an overview of financial statements. You didn't take this class to learn about finance specifically in depth or accounting it specifically in depth, but there's some basic things you need to know for some of the things we're going to talk about throughout the class to make sense to you. So that's really the purpose of this little introductory video. So the objectives here are to learn the importance of financial statements for all organizations. They identify the three major financial statements: income statements, balance sheets, and cash flow. Understand the basic differences between them, and achieve a basic understanding of how they interact with each other. If you find any of this very interesting, you would love to take an accounting class, probably maybe a finance class as well. Okay, so let's look at this, and as we think about what these different statements are, and a good way to look at it is looking at it on these dimensions, on the dimension of time, the purpose, the measures, the starting point, and the ending point. Okay, so an income statement is for a period of time. So typically it says an income statement between January 1st and December 31st of the year 2023. Okay, so that'd be a one way to define it. It's not always a year. But a lot of times when you see income statements, they look like that. Its purpose is ultimately to find out the profitability of the organization, okay, in that period of time. The measures it looks at are revenue, or you can think of that as sales, the expenses required to generate those sales, and then you get a sense of profitability from that. The starting point is revenue, and the ending point is net income. So net income is basically revenue minus the expenses, gives us this idea of net income. That's an income statement, okay? A balance sheet, however, is very different. It's a financial condition of a company at a specific point in time. So instead of saying for this period of time, it says as of December 31st, this is the financial condition of the company. Its purpose is to talk about its financial position. We look at assets, liabilities, and shareholders' equity are the three components that go into a balance sheet. We start as the starting point is basically cash balance, and the ending point is retained earnings. In other words, the money that we make, how much of that do we retain in the organization, not distribute. Okay, so that's a balance sheet. We're going to take a little closer look at that. A cash flow statement is like an income statement in that it's a period of time, but instead of measuring profitability, it's measuring cash movements. Okay, if you get into this in accounting, it gets a lot more complicated than what I'm going to describe, but you get the basic gist of it from what I'm going to talk about here. But basically, it's measuring the increases and decreases in cash over that period of time. Its starting point is net income, and its ending point is the cash balance. As you can see, some of the things that are listed here as starting points and ending points kind of cut across, and that's how they tie together. That's how all three of the statements tie together. Okay. All right. So this is a typical income statement. We look at a lot of things. A lot of times you'll see it listed in comparison to the previous year or the previous period of time that it's measuring. And it starts with a basic revenue, which is just basically what the sales of your products and services were, the money that the sales that you generated by to support your business. That's what goes under revenue. And then we look at the direct costs associated with generating that revenue. So let's say we make, for example, I'm trying to think of something simple, paper, cut, paper that goes into a copy machine. Okay. That paper, we pay, the cost of it is the cost of producing the paper, the cost of the paper itself. Okay. The whatever process, costs go into that. The wrapping that goes around it, the box that goes into, all of those are directly associated with the sale of the product. Okay. And the sale of the product is a package of paper. Okay. When I subtract out the cost of the goods sold, that's cost of sales or cost of goods sold from revenue, I end up with something called gross profit. So let's just say I get $100 for packages of paper, and the cost of those, cost to produce that is $60. That leaves me with $40 of gross profit. Revenue minus $100 in revenue minus the $60 in cost of sales leaves me with $40 in gross profit. Just as a side note to that, gross profit margin, you'll hear that term cited a lot. That is basically taking gross profit, dividing it by revenue, and it gives you a percentage. And in this case, it would be 40%, gross profit margin of 40%. Okay, so that's the top part of it. Then we add in other types of income that the company might have, from interest, different types of things that different activities they have that are not directly related to what the company does. In this case, producing paper. There's just other types of income that we have coming in, so we account for it that way. And then we have the cost of distribution, administrative expenses. By the way, paper is real expensive to ship, so could be a pretty significant cost to the paper company. Administrative expenses are just all the salaries and all the other types of expenses we have relating around that. Finance costs is we borrow money to operate our business, which we might have to do. Then we're paying interest on that, and that expense is taken off of our income right here. And we end up with profit before tax. And that's that kind of net profit figure. Then you may have heard the acronym EBIT, EBIT, or EBITDA. I won't go into a lot of details on this stuff, but you'll hear that or you'll read about it about companies. So EBIT is earnings before income taxes. So that's just what we're looking at here, okay? Which means whatever earnings we had is what they're going to calculate what we owe in income taxes on, okay? EBITDA is EBITDA is earning before income taxes, depreciation, and amortization. I'm not going to go into all that stuff. We'll talk about it a little bit when we talk about accounting. It's a very complex subject, and I won't go into a lot of it, but you will come across this when you look at income statements for companies that you might be looking into, okay? And that'll give us for the profit for the year. Now, the last thing we want to look at from a standpoint of earning income is we look at earnings, and sometimes you'll hear this term used. Earnings per share is basically a ratio. It just says if we sell a share of stock is a stake in ownership of the company and the equity of the company. If I sell a share of stock and then I have one, so the earnings per share is whatever my earnings are divided by the one share of stock. Now, if I have 100, it's only 1/100th of the earnings that we have, right? So it's divided by 100 shares of stock, and it gives us earnings per share. Now, don't be surprised, a lot of large companies have hundreds of thousands of shares out there. So you can see where this is a pretty important number to take a look at. It tells us what the earnings are relative to numbers of shares of stock. Okay, that's an income statement. A balance sheet, this is not the best picture of it, I'm just going to say right off the bat, but a balance sheet is basically taking the company's total assets and then looking at the company's total liabilities plus the equity that the owners have in the business, okay? It's called a balance sheet because the assets have to equal to the equity and the liabilities. Okay, so it's a balance sheet. So if you're taking an accounting class and you're doing a balance statement and that equation doesn't hold true, you did something wrong. You got to start over. Okay, so it always balances out, right? So assets are all the things that the company has that actually produce what the company does, revenues for it. So the assets are looked at in terms of non-current and current, which we typically are looked at from the standpoint of anything that is liquid in 12 months or less. In other words, I can turn it into cash in 12 months or less, and things that are not. Okay, so current assets include things like inventories. If you've been selling to people on credit, how much they owe you, the amount of cash you have around, that type of thing. Those are current assets. And non-current assets are things like property, plant, and equipment. Paper mills, they're pretty expensive to build, so you can get a sense of that. Goodwill and intangible assets are also non-current assets, and we'll talk about that more when we get into the accounting. And then under liabilities, that's what we owe typically to pay for the assets that we have. Okay. So if we bought, let's say, for example, a truck to deliver it, we might have bought that on a note. We might have bought that on a loan, and what we have outstanding on the loan is considered a liability. Okay, and the same thing is current and non-current. The current liabilities are ones that are easily converted in less than a year, and non-current are those more long-term borrowings. So and a lot of companies have those types of things as well. And then what's left basically is what the shareholders have in terms of the value of the company, which is how much the retained earnings were from the year before that gets added in, and then we look at how much the what the shares of stock actually own is basically assets minus liabilities. Okay, so that's a balance sheet that gives us the financial condition of the company at a point in time. And then the last thing we look at is cash flows. Cash flows are just like they sound. We have money coming in from different activities that we have. It would be from operations or whatever, or investing. And then we have cash flows going out. Okay, so you could do, and you end up looking at a net cash position there. Do we have more or less cash relative to how we started the period of time? Okay, and so that's an important one to look at as well. Kind of shows how liquid the company is and how efficient their operations are. Okay, so that's a cash flow, all right? I'm not going to go into a lot of details here, but I'm just going to point out to you that yes, they all kind of tie together, all these statements, and you can see how it starts. So the balance sheet at the start of the period is what we add and subtract things from, use it from the cash flow statement and the income statement as well, and all those things get calculated, and then we end up with our balance sheet at the end of the period of time. Okay, so I'm not going to go into a lot of detail. If you take an accounting class, you'll spend a lot of time reconciling these things, but that's not what this is. I just want you to understand how they all tie together. This is another view of that, okay, how they tie together. And believe me, I'm not going to ask questions on a test that are that involved, okay? So cash flow analysis, is something that we might use these statements for. For example, we might have let's say a movie theater or something like that. We might add a person. Let's say in this case we're looking at in March, we add them in. Of course, we have cash going out to pay them. And when we look at our net cash flow, it goes from a positive to zero, but then it supports our growth, which allows us to get our net cash flow back to being positive because we have this additional employee. So that's something we might want to take a look at. I'm not going to go into this in a lot of detail, but we can look at cash flows in a lot of different ways, and it's a typically used financial activity to help us understand whether an investment's worth making or not. Okay, and you could do this for yourself, and if you care to do it and you want to kind of share it with me, you can. This is not an assignment, but just do it for fun. I mean, not for fun, but something that might be helpful for you from a standpoint of budgeting. You can think about the wages you have coming in. You can think about the different types of other cash that you have coming in, and look at the total cash in, and then you look at all the different things that you're spending money on, and that's cash going out, and you look at it over a period of time, and you see, do we have a positive cash flow at the end of all this? If you do, my suggestion to you, invest it immediately, so you can get some good returns. Okay, but it's a worthwhile. You can do this for yourself, and it's kind of fun to do. All right. If you have any questions about that, do not hesitate to reach out to me. That concludes this video.